All right, let's talk about the secret language of business. And no, it's not some super complex code. It's actually a single beautiful idea that's the foundation for, well, pretty much all of finance. And once you get it, I promise, you'll start seeing it everywhere.
You know, it all really boils down to this one simple question. Doesn't matter if it's a huge tech company or a tiny coffee cart on the corner. What stuff do they have, and how on earth did they pay for it? The answer is surprisingly simple, and that's exactly what we're going to unpack.
So, to get to that answer, we first need to get familiar with the three fundamental building blocks of any business's finances. Let's break them down one by one.
First up, assets. The easiest way to think about assets is that they're all the valuable things a business has in its toolbox. So, let's say we're starting a little coffee cart business. Our assets are going to be everything we have that helps us actually sell coffee and make money.
Let's make that real. For our coffee cart, the cash in our bank account, that's an asset. The physical cart itself, the espresso machine, that's equipment, so it's an asset. All our coffee beans, milk, and cups, that's our inventory. And yep, it's an asset too. Heck, even if a local office orders a bunch of coffee and says, "We'll pay you next week," that money they owe us is an asset. It's all the stuff the business owns.
Okay, so that's what we own. But what about what we owe? That brings us to our second piece, liabilities. These are basically the debts of the business. It's any claim that an outsider, someone who isn't the owner, has on our stuff. It's money we got to pay back. For our coffee cart, maybe we took out a small bank loan to get started. That loan is a classic liability. Or what if our coffee bean supplier delivers our beans with an invoice that's due in 30 days? That bill is also a liability. It's the IOUs of the business world.
And that, of course, leads us to the third and final piece of our puzzle, capital. Think of it this way. If you sold all your assets and used that cash to pay off all your liabilities, whatever is left over, that's the capital. It's the owner's personal investment, their stake, their slice of the pie.
And this is the crucial difference. You can see it right here. Liabilities are what you owe to outsiders, banks, suppliers, you name it. Capital is what the business owes to the owner. They are both claims on the company's assets, but they come from two totally different places. Borrowed money versus the owner's own money. So, now we have our three building blocks: assets, liabilities, and capital. The cool part is how they fit together. It's like a perfectly balanced scale, and we're about to see the formula that keeps it that way.
And there it is, the accounting equation. Assets equals liabilities plus capital. It's so simple, right? But here's the magic trick. This equation must always, and I mean always, be in balance. What's on the left side has to equal what's on the right side. No exceptions.
This is why it works. Just think back to that very first question we asked. What does a business own, and where did the money come from? Well, this equation is the answer. Everything the business has, all its assets, had to be paid for somehow. And there are only two ways to do that. You either borrowed the money from someone else, which is a liability, or you use the owner's own cash, which is capital. That's it. Every penny is accounted for.
Okay, theory is great, but seeing this thing in action is where it really clicks. So let's bring our little coffee cart business to life. We're going to watch its very first few moves and see how the equation stays perfectly balanced through it all.
Here we go. Day one. The owner takes $100,000 of their own money and puts it into a new business bank account. The business is officially born. So, how does this change our equation?
And boom, perfect balance from the get-go. Look at that. The business's assets just went up by $100,000 in cash. And on the other side, the owner's claim, their capital, also went up by $100,000. This is what's known as the dual effect. Every single transaction hits at least two places. Right now, our equation reads 100,000 equals 0 plus 100,000. It's perfect.
Okay, next up, we can't be a coffee cart business without a coffee cart. So we find a great one for $30,000 and we pay for it right out of our business bank account.
Now this is interesting. Notice how the right side of the equation didn't change at all. All we did was swap one asset for another. Our cash went down by $30,000, but our equipment went up by $30,000. So the total value of our assets is still exactly the same. The equation stays balanced because we just moved some money around on one side.
All right, we need beans. We find a supplier, order $20,000 worth of coffee, and they tell us, no problem, pay us next month. This is what's called buying on credit. We get the goods now, but we pay later.
And here we see another kind of balancing act. Our assets went up by $20,000 because we now have all that coffee bean inventory.
But since we didn't pay for it yet, our liabilities also went up by $20,000. We now owe our supplier. See? Both sides of the equation increased by the exact same amount, still in perfect harmony.
So, as you can see, this simple formula is so much more than a neat party trick. It's the absolute bedrock of all accounting. Let's just wrap up with why this is so incredibly important. If you take anything away from this, it's these 4 things. 1. The equation always balances. It's non-negotiable. 2. Every transaction has that dual effect we saw. 3. It gives us a crystal clear snapshot of everything a business owns. And 4. It tells us exactly who has a claim on all that stuff. Look, this isn't just me saying it. This equation is the heart of it all. It's a self-checking system that forces everything to be accounted for. It's what gives us a reliable, accurate picture of a company's financial health at any moment in time.
And you know what? This isn't just for businesses. You can apply this exact logic to your own life. Think about it. What are your assets? Maybe a car, some savings. And what are your liabilities? Student loans, a credit card bill? The difference between the two? Well, that's your personal capital. So now that you know the grammar, what story does your own accounting equation tell?